Do you read me?
Be advised, you are coming in weak and unreadable.
Say again, Com Tower. This is Pacho. Do you read me?
Pacho, this is Com Tower. I read you Lima Charlie.
Com Tower, Com Tower. Request permission to launch and commence the field op. Over.
Stand by. Pacho, permission granted. I say again, permission granted.
Roger that. Launching podcast in 3, 2. You are now entering the field op with your host, Pacho Correa, Chief Warrant Officer 3, United States Marine Corps retired. Get some. Hurrah! Get some, hurrah! What's going on, everybody? Welcome back. Another week is in the books. Friday night's Eve, baby Friday. Goddamn, it's almost the weekend. Hey, we got a really good show for you today. Before we get started, let's get all the pleasantries out of the way. Hey, when was the last time? Have you put in for your VA benefits? Have you ever thought about, what you're gonna do when you start winning? With some of that money that compensation that you're getting from the VA, or are you on target to retire whenever it is that you want to, stop working? Because remember, retirement is not an age; it's actually a financial figure. So if you go to meetthemoneypro.com, you could go there and book a 1 hour free strategy session with yours truly. I will give you some very specific strategies and techniques that will help that you can start implementing actually right away. Kind of goes along with some of the things that we'll be talking about today in the show. But not only that, but it'll actually paint you a real good picture as to, hey, am I on target? Am I not? And if something makes sense, we could talk about how is that we can help you achieve your not only your financial goals but get you out of debt, among many other different things. So no pressure, no commitment. Again, if something resonates and makes sense at the end, we could talk a little bit more. If not, that's okay too. At least you have options and you have things that you can actually start implementing right away. Also, not only that, but when was the last time you took a look at where are you on your VA claim? Just like I put on a TikTok on a TikTok that I made the other day on the TikTok channel is, have you been considering applying for VA benefits and paying somebody to do this for you, like a lawyer, one of those companies out there? It's like, we call them claim sharks, paying thousands of dollars, maybe even giving up a portion of your VA, whatever it is that they get you, giving up a percentage for a couple of months, just so these people get you somewhat of a desired or maybe undesired outcome. Well, if there's something that resonates with you, you could go to also that website, meetthemoneypro.com. I can, give you a free 1 hour strategy session, and I can show you how is it that you can actually, apply for your VA benefits. And if something makes sense, great. And whatever winnings you get, you can actually, implement that into your financial planning so that you can achieve your financial goals. Again, now is the time to apply because under the PAC Act and many other things, the system is being revamped, and I think we're going to see a lot of good things coming out with the VA as far as compensation and VA claims and benefits. So I highly recommend that you do that for your own good. Okay, because the last thing you want to do is pay thousands of dollars and not really get any headway, or end up giving a portion of your uh, claim or benefits, like some of these companies do. So think about it, and we could talk about it, talk about it as well. And again, if something makes sense, we can go further from there. All right, because again, this is your claim and benefit. So this show is also too all about supporting uh, the right to bear arms, the Constitution, and many other great things, that the freedoms that we have as Americans, and those of us who served in every climate and place, defending it, America in the name of freedom. So give us, if you like the show, like, subscribe, and follow. Let everybody else know about it. I have some amazing things out there, some information out there that you can benefit from. And if not, hey, check out something from Sitchradio.com. They're the folks who've been helping the show for many years. So shout out to Brian Colburn. If you need help, ideas, anything else, coaching, mentoring, Brian Colburn, you can book a session with Brian and you will be highly pleased. I highly recommend them. All right. So that's pretty much all the pleasantries. We got all that stuff out of the way. So let's kick off with the show. I was actually helping uh, fellow veteran this week, and over the last couple of weeks, the market, has been. We can talk about tariffs and this and that, and all the other things going on. And but at the end of the day, folks, the market is going to fluctuate. So I thought about, what, this is something good to talk about because there's a lot of misinformation out there. So we not only do I break down the show live after the service, but I also want to talk about, not just in regards to fitness, but also financial fitness as well. I- You know, Figuring out, hey, what's an IRA? How do they work? So kind of today's mission is to decode the world of investing. So we're going to talk about things like open-end funds, closed funds, stocks, and why a lot of us need to stop playing financial whack-a-mole. That's the game where you're, when you're at the arcade and you're beating up these little groundhogs that moles that stick out of the, because that's what when I meet it with a lot of not only fellow veterans but also clients, as somebody who is licensed in the US in this industry, you need to, not really play Russian roulette or gambling with your finances, because you may think you invest in the right thing, and if that company, if you once you know the difference of the things we'll talk about today, it'll give you hopefully it'll give you a little bit of a more perspective. And if you want further information, we can set up again. I can show you more in detail what I mean. So because investing is not just for Wall Street. uh, it may seem intimidating, when you hear when you talk to people, like, because there's a lot of jargon out there, people that, options, uh, dividends, people talk about, pork bellies, commodities, all that stuff, but it's just another skill set to that you're going to learn. And it's kind of like land and a half a little bit, where, or like learning how to field strip your weapon. What I'm saying. It's like once you learn the stuff and how it all comes together. It's not as complex as a lot of people, or as you see some of these commercials on some of these companies, because finance is whatever. And there's a lot of them out there. I'm not going to point fingers and name companies, but it's just they try to make it seem very complex when it really isn't. It's just what avenue approach you go after, utilizing the folks that are already licensed in the industry so that they could get you in there. Or if you want to get licensed, you talk to me. I can also help you with that. But the idea is very simple. You protect your income, put your money to work for you over time. You guys heard me say plenty of times that you want to that I read a lot, right? And we've talked about several books in this book in the show. Think and Grow Rich. We've talked about 3 Feet from Gold. Napoleon Hill is one of them. Another amazing book that I think everybody should read. Not, this is not about a show, but it's called The Richest Man in Babylon. It's the best 110 pages that you'll ever read. And the audiobook is even more amazing because the person who does the voices, that dude knocked it out of the ballpark. But so you buy term and invest the difference. You've heard me say that before. So the master is to protect basically what matters and grow the rest of your money, right? So what? So let's talk about one thing first. Open end. What is an open end fund? Okay, or an open end management company, right? So open end funds is basically your straight up, off the mill traditional mutual funds. You've heard the word mutual funds. There's, let me just dive in a little bit more into that, so that way the difference. So uh, open end company or open end traditional mutual funds, the shares are bought uh, or sold, what they call that net asset value, or NAV. What is the NAV? Is that let's say you need some type of amount of money. Let's say you borrow from your 401k. that is a perfect 401k or your TSP. You borrow from those are called qualified plans or employer qualified plan. Why is it qualified? Because under the IRS eyes, you're deferring you're paying taxes on that stuff later in life after the age 59 and a half or 60 years old, just to round it up, right? So you need to borrow money from your 401k or your traditional independent individual retirement account IRA, right? You need to borrow some money. So you liquid if it's from a mutual fund, not stocks. You go to your mutual funds. It could be the lifetime fund, that this, and TSPs, they use the L 50 40 plan. Your company may have a lifetime fund or something, right? So you liquidate those assets, right? You sell them, you put in the order, or you borrow, hey, I need to liquidate this amount of money because of whatever reason. Well, that goes to back to that mutual fund, or the company that uses it. Could be Fidelity, whatever it is that your company is using, for example, or wherever you have your traditional IRA, and they're going to go back and sell back to that mutual fund, that company, because in the mutual fund they call them pooled investments, because inside that fund it could be, there could be Amazon, there could be, as these are not recommendations, these are just, I'm just saying, they could be Amazon, S&P 500, you could have Walmart, you could have all kinds of different companies inside that fund, right? So it's going back to, and let's call the fund the military fund. I just said. So it goes back to them, and at the end of the market closes at 1600, 4 o'clock. Right before it closes, it's going to do this called evaluation, where it's going to do an average, whatever, and whatever the calculation is, and that gives the price that, hey, anybody liquidating any mutual funds, this will be the price that that person will get. So it's that price at the final day that your mutual funds are going to get liquidated at, right? And that's when, once the order hits in 2 3 days, whatever, that money's back in your account, and that's what you get, right? So those are mutual funds. All right. And an open end management company, it's constantly in an initial offering, right? IPO, initial public offering. So it never goes, and we'll talk, that's the difference between stocks and mutual funds. So not to confuse everybody. So more shares can be created as more investors join. So again, it's always at first offering. Mutual funds always at initial offering. So you'll always get the best price on them, in technically, right? And you can keep buying little pieces. You don't have to buy. You could buy two, three equities or pieces of that mutual fund, instead of having to buy 100, what we call a round lot, like you do with stocks, right? So you're never locked out, right? Uh, and the cool thing is that mutual funds are professionally managed, and that they're diversified. Professionally managed one is that there's a person constantly managing this thing. I know there's other ones that are not, but we're not talking about that today because that'll be another show. So there's a person, and they're making sure that all the companies inside that fund are performing. That there's not a bad apple that's about to go broke or out of business. Be way before they'll see that coming, and like, oh no, we got to get rid of this company and bring another one in, right? So, and they're diversified. Again, you could have big companies. You could have Coca-Cola in there, which is a mega, it's a mega, what do you call them? A mega capitalization company. No, it was that. Hey, it's a giant. You can have Amazon, which is another large capacity company. In other words, income, right? Uh, or it may have a little bit of startups, companies that are just coming up and coming, right? So it could have all kinds of different small, middle, large type of companies inside, and liquid in the sense that, hey, I need that money, I need to sell. Well, I can liquidate them, sell them at the end, and at the end of the day, I'm going to get the best price. Best forward pricing is what that's what net asset value is, right? So in my notes I have great for long-term savers. Yes, and no, because you can use mutual funds. There are short-term mutual funds as well that for short-term accounts, 2 3 years. You need to save up for a house. You can do those as well, right? So it's like going to a chow hall a little bit. You show up hungry, and they'll find a way to feed you, right? And in other words, that hey, I'm here. I want to invest, and what's good, right? Now let's talk. So we have open end. Now let's talk about closed ends as well as individual stocks. Okay, because these are pretty similar, right? Uh, with closed ends, it's they have a fixed number of shares that they're gonna sell. Hey, we're gonna go public, right? We only have 100,000 shares, and then the company has this offering, is what they call it, and then people buy it, boom, it's closed, everybody is happy, everybody bought into it, and then no more, that's it. Then when you try to sell them, but I'm kind of giving you the whole end. When you try to sell them, there you're not going to get the best forward pricing like what you do with mutual funds or an open end fund. Now these are different because now you're selling at supply and demand in the secondary market, which is the New York Stock Exchange. So a lot of people people confuse the two: mutual funds, IPO, New York Stock Exchange, completely two separate animals, right? So and again, because they're on the stock exchange, that's those prices do fluctuate like stocks, and they can trade like a secondary or a closed-end mutual fund. The prices fluctuate along with the kind of like with stocks. So you can have a mutual fund that's a closed-end company, and you just bought into it one time, and then now you try to sell it. The price, you're not going to get the best forward pricing. You're going to get is it could be, say, hey, the price is $100, but supply and demand, people are buying it at just at $50. You just lost $50. I'm just using it as a really really simple um uh y- you know example. Or it might be at at $100, but because everybody wants, and this is the greatest thing. Now that this fund is in, people are buying it at 120. You just made $20, right? So, but in reality, they're less liquid. May come with volatility. That it fluctuates a lot. Up and down. So and there's fewer options for automatic investing. So you know, um, and it says it's like boarding a Navy bus. When it's full, you're waiting or paying a premium, right? Uh, and same thing. Let me tell you, because closed-end mutual funds are very similar to stocks. When you buy stocks, now you're buying equities or securities of or a piece of one company. Let's say I'm buying stocks of Amazon, right? Mutual funds, whether they're closed or open or closed, there's a lot of companies inside of them, 70 to 300. Stocks, now you're just betting on one pony. So here you got a little bit more diversification, a little bit of this and a little bit of that. And stocks, yeah, they're higher risk, potential reward, high risk, high reward, but also, there's no diversification. So that's why if everybody here is going to go back tomorrow, well, let me open my 401k. Let me see, is it diversified? Meaning that is it in different markets, or that's why you'll see most companies on average won't let you, which was the case for my 401k plan when I was with corporate, is it would only allow me to buy 20% of my paycheck could go into buying stocks for the company. The rest had to be put on mutual funds and different types of funds. Okay, so you want to do a little bit of research. You could call the folks. Some of you may be serviced with different types of companies. For your 401k, and ask them, hey, how am I diversified? Sometimes the rep on the phone is not a licensed individual, so they can only give you very vague answers. Or they may say, hey, talk to one of our licensed representatives. However, most of the time, if you don't got about at least $25,000 in that account, you might not just talk to anybody. You might just get some generic answers. I'm telling you because I dealt with those people sometimes, right? So uh, So, and with individual stocks, it requires ongoing research and emotional discipline. What do I mean by that? Well, if the market tanks or takes a dip, and I'm not saying that if the market takes a dip, investing is very emotional. So a lot of people, again, I'm in the industry. I deal with this a lot. Where when the whole tariff thing was going, and the market has recovered. It's recovering. So, but people is like, hey, what's going on? I need to liquidate, and it's like, hey, calm down. Actually, when the market dips, especially with mutual funds, open end, the market is for sale. You should be, if you can, and you have discretionary funds, you should throw it, a little bit more in there because you're buying everything. Again, it's very emotional, and the easy thing would be liquidate, and that's where you hear a lot of people they buy high and they end up selling low. That's where people say because people bought, oh man, you should buy this stock. It's the latest and greatest. It's this, and people because they heard it from a friend who's a sure thing, and now you bought at the height of the market. Then the market, fluctuates. It takes it takes a little bit of a dip, and then people's like, "Oh my God, this thing is going to tank," and then they sell. You just lost, instead of when you bought them at $100, now they're worth 50. You just lost $50, and then that's the easiest example I can use. So try to refrain from doing that, especially with mutual funds, and the first one I talked about, the open end one, because at that point, you got to be disciplined because what goes down is got to come back up. So if you buy at a low, you're going to have a lot more. So when it goes up again, then it's what the pool that you have is going to be worth a lot more because now you bought more at a discount, and it's going to be worth more. Okay. So that's why you can't, you got to work with somebody that's in the industry, and who knows about this stuff, so that way they can keep you sane. A lot of people, where people get in trouble is that, because again, I talk to people that I help, and they're like, oh, I did this, but I got burned and I lost my money, and it's like, well, who was that was helping you? Oh, it was my friend. My friend told me about it, and I lost everything. And it's like, well, is your friend a licensed individual? Did he help? What products did he help you? I start asking questions. What products did he help you with? What license? And oh no, he just told me because I heard it from a friend. So if you're gonna do it, now that there's a lot of people out there that do this on their own. However, they do a lot of research, and they read, uh, and they're kind of more prepared than the average person. So, but however, there are day traders out there, people who are licensed and do day trading and all that stuff. So, the burden is on you. Where if you work with somebody who's licensed, they're going to put you in vehicles that are going to help you, and are going to, it'll make your money work for you. Because at the end of the day, that's what you want to do. Just like the book, The Richest Man on Babylon, which I highly recommend you read it. That essentially you want your money to work for you. You want that money to create more money, and the other money it keeps creating, it keeps investing, right? So because that's why most families benefit from simpler investment vehicles, right? For most people, investing through open-end mutual funds or index funds is simpler. It's easier. It's more consistent. There's lower maintenance costs because look, a lot of people say, "Oh, the fees, the this, the that." I'm telling you, look, if you are on a 401k, you're paying fees. I'm telling you right now, you're paying fees, which when you every paycheck, your employer takes out a little bit of money, then and then because you're doing the 6% match, and they're going to match you, that money goes into that mutual fund, and each drop, that mutual fund may charge maybe 4.5, 5%. So just to put in perspective, if you're investing in total between you and your employer $100, you're just paying for $4 or $5 as a fee each new money, right? Each new money, one time. What does that money do? Well, that money pays that mutual fund manager who's out there busting their butts, making sure that it's performing like it's supposed to, you know, and paying the bills and whatever else. I mean, in a simpler form. That's what all that means, right? So, uh, lower maintenance costs. Whereas if you're paying a day trader, that's a whole lot different. I mean, it's a different class. But I'm telling you, you're paying fees. So if you wanna, once you leave a job, you want to transfer that money out of it. You never, and again, eh, you never should leave it there or leave your TSP there, not doing anything. You want to bring it somewhere where you can still contribute. You can still do all things, make that money grow, right? So and one thing that we always talk about is doing dollar cost averaging, right? With automatic contributions. What does that mean? Is that you contribute on a 401k, that's doing for dollar cost average. You contribute to your TSP for those who are still in the service. You're doing dollar cost average. The simplest explanation on that is that you're investing $100 religiously, right? First month, you're buying cows. I'm just using it as an example. You bought cows. With that $100, you bought 5 cows. The market dipped. Now, it's on sale. So now, instead of buying 5 cows, because the cows initially were at $20, then now the market dipped. The cows are worth 10. So you just bought 10 cows. So now you have 15 cows. The next month the market goes up. Uh, cows are now worth at $50, right? You bought two. But when and steadily just like that, as so when you do the math, you bought a lot. You all those cows that you were buying steadily at $100, you actually bought at a discount and at a lower price. So that's why you want to you want to just steadily invest, whatever it is, $100, $50, whatever. Something is better than nothing, steadily, right? Uh, because the long term strategy is gonna win. Example: $200. Here's something to think about: $200 a month for 35 years with a modest return is gonna build you wealth significantly. We talked about compounding interest. Compounding interest is the best thing because essentially it just that money essentially every so many years that money is going to double, right? And there's a lot of vehicles out there that are going to help you. Again, you're using the rule of 72. If you divide 72 by your interest or return that you get from an investment. So if you have an investment that's giving you 3%, that means that your money is going to double every 24 years, which is it's a long time. The higher the return, the lower the time frame. So, and there's a lot of if you get 9% return, your money doubles every 8 years, and that's feasible. That's good, right? So you use compound interest. When it comes to investing, it's your best friend. But if you owe credit cards and debt, compounding interest is your worst enemy. I mean, talk to any PFC that's maxed out their military start card. Um, and owes a lot of money is underwater because and now they're talking to First Iron or Sergeant Major because they don't know how to manage their bills, right? So you wanna you wanna do a little bit of research, and if you need help with that, you can hit us up at the show. So you want to pair with your investments with the right vehicle, right? So for example, a Roth IRA, that's money that you're funding this vehicle essentially becomes tax free. Contributions made after tax. No, your money was taxed, hit your bank account, you put it in this individual retirement account, and that money has already been taxed. So withdrawal, and so essentially later on, and that's another long term investment vehicle for later on in life. There's no required contributions. It's flexible. It has early withdrawal rule. It does have flexible early withdrawal rules, but that's okay too. It's ideal for service members. Why? Because when you invest, it's all long term, folks. It's all long term. If you're doing short-term investing, high risk, that mean you must be a day trader or something, of the sort. So, and you can lose, yeah, you can lose your if you really don't know what you're doing and you just kind of like winging it, you can lose a lot of money, as I know a lot of people that have. Okay, so or traditionals. Again, we talked about those are employer plans, very simple as well. So you don't want to get into investment vehicles like these whole insurance policies that you hear out there. You're watching on social media, Index Universal Life, IULs. That's the new one that I hear in this industry. That you can borrow against it. You can. It's tax free and that is guaranteed because look, all those policies, those are a scam. It's a legal scam, but there's no such animal as insurance investments and insurance and investments mixed doesn't exist. Whole life, index, universal, variable life. They come in many different names, but it's a cat. It's we call those trash value policies. I'm telling you, folks, you don't want to get into that. And there's a lot of companies selling these things. You're better off buying a pure term insurance policy, and whatever money that you want to invest, so you have extra, put it in an investment vehicle like a mutual fund. Again, these are not recommendations. I am licensed in the industry, and I'm telling you that you want to do right by you. You don't want to put those vehicles will not yield you your desired outcome because you got people who sell these products talking very sexy language and appealing and all over your eye, but then they don't tell you all the things that come with it. All right, so those are some things to think about. Cheaper. It's again term life is cheaper than whole life. It allows you to invest the difference. If you protect your family and you build wealth through actual investing, because on those IUL, infinite banking, another sexy name that we heard, they're going to cap you at 7%, and then they're going to invest. The insurance company is going to invest in the market, getting maybe 12% return. They're going to keep the difference and give you the 7%. So you gain you and but they'll scare you saying no because the market is going to tank. The market hasn't crashed since the 1930s, folks. So regardless of the dips that we've had in 2008, before COVID, the market has always recovered. Okay, so some of the key takeaways from today. Believe me, I could spend an entire week talking about these things. I mean, the information. I mean that, and again, as a licensed individual, I mean, I had to study, a manual. I mean, we could do an entire presentation, a period of instructions. Remember those from the Marine from you when you were in the service. But open end funds, good for steady long term investing. Closed end, less common, more complex. Uh, it's kind of like owning stocks a little bit. I mean, that's the simplest way to explain. And stocks, it has potential upside, but they're risky without guidance. And there's already been a study that was done, I think in the 70s or 80s, where basically they had kids and monkeys pick stocks, and then a light somebody, there was no correlation in between the two. So it's basically like, hey, this may do, yeah, nowadays we have AI and all these other things, but again, it's not. There's nothing guaranteed that you know that out there that you're gonna you make a lot of money. Again, it's all about educating and knowing and all that stuff. So you want to have a balanced strategy for protecting your growth, right? And again, growth wins. Something steady, nice and steady, wins over hype each and every time. So review your plan. Are you covered? Are you covered? And are you really building? Or are you being helped by somebody that knows? So hope is not a strategy. Okay, it's a solid investment plan is gonna get you there. Retirement is not 65, folks. It's actually, do you have enough money to sustain you once you decide to work. So if you need $50,000 every year until you pass away, on average 85, 87 years old. So do you have, once you stop working, 20 years worth of monies that you can live off without depending on your kids financially for the rest of your life? So if you want to know what that financial independence number is, by all means, you can hit me up at the show. I can actually, what it's very easy to do the calculation, and it could be very eye opening. Trust me, it opened my eyes when I did it on myself, and I was like, holy shit, I need that much money. But it also put me in perspective and put me in the right path. to hit that target number. So remember, folks, uh, you want to you want to get there. You want to do it with somebody that that can guide you along the way. All right, because again, the life that you may help could be your own. So with that being said, I think this is a good stopping point for the show. If first of all, I want to give a huge shout out to my sister. She's a big supporter of the show. You're doing amazing things. We're all proud of you. Keep going because you're on the right path, and we're extremely proud. And I'm glad that we're reconnecting and building our relationship once again. And if you've been ruminating, you've been going into that dark path, you don't know what to do and all that good stuff, you can by all means please reach out to the show, reach out to me, reach out to somebody. There's Military One Source, TRICARE, suicide, the Veteran Suicide Line. There's a lot of things out there because it's better to reach out and get the help because all crappy times will pass. Nobody wants to be at your funeral. Nobody wants to, talk, give you eulogy. Nobody wants to do all those things. We want you here and we want to be able to help you. So that's it for today, everybody. So with that being said, I think we're gonna go ahead and end this. So ice the mas, dice the key. We'll see you next week. Hurrah! Get some. Bye bye, everybody. Take care.